There are many tough decisions you're going to need to make when obtaining a mortgage, and one of those is what length term is best for me. And what I mean by that is what length mortgage term. Is it a 30-year, a 20-year, a 15-year, a 10-year? So in this video, I'm gonna give you the pros and cons of the two most popular mortgage terms, the 30 and the 15-year fixed. And at the end, I'm gonna show you a trick to save interest on your mortgage. But before getting into comparisons, you need to consider the following. One, what is your risk tolerance? Meaning your comfort level with the debt and the monthly obligations, because this can greatly influence your choice. Two is, what are your future plans? You need to consider how long you plan to stay in the property, because shorter stays may not benefit you, because the quicker equity buildup of a 15-year loan is really only beneficial in the long term. It may be more important for you to have a lower monthly payment for the time that you're in the property and earn equity through the appreciation of that home's value. The interest rate environment is also something you need to consider. A lower interest rate environment means that you can lock a lower interest rate on both a 30 and a 15-year mortgage. For example, when rates dropped to their lowest point right after COVID or right at the mid-COVID, there was a substantial difference in the rate you can get on a 30-year mortgage versus a 15-year mortgage. In today's interest rate environment, not so much. And you want to consider inflation, because over time, inflation can actually erode the real value of your payments, which would make longer term mortgages more appealing. So let's get into our comparison, and we'll start with a 15-year fixed rate mortgage. So let's talk about the pros first, right? So 15-year mortgage typically comes with a lower interest rate versus a 30-year, of course, right? The shorter the term, the less time the lender is agreeing or the bank is agreeing to lock the term in. Therefore, they're going to offer you a lower interest rate. And like I just said, when rates were at their lowest point, the difference in the rates was substantial. We had 15-year mortgage rates at 1.75%, which is crazy. And at the same time, the 30-year fixed rate mortgage was around 2.75%, also extremely low, but that's a 1% difference between the two, which is pretty substantial. In today's market, you only have a difference of about 0.5% between a 30-year mortgage and a 15-year mortgage. Now, another pro is because it's a shorter term and the rate is typically a little bit lower, you're going to pay less interest over that term, right? The shorter term means you're paying less interest because you're actually paying more money toward the principal faster, and you're paying that home off faster. Therefore, you're saving on the amount of interest you're going to pay. Clearly, if you're only paying interest for 15 years versus paying interest for 30 years, you will pay less of that interest. You're also going to build equity faster because you're paying more money toward the principal balance on the property than you would be on a 30-year mortgage. 30-year mortgages are more front-loaded on the interest, and I'll get into that after, than a 15-year mortgage is. So you pay down the home faster, you're paying off the mortgage faster, therefore you're building up equity faster, strictly based on your payments, not based on the appreciation. It's going to be the same appreciation in your home's value regardless of the length mortgage term you take, but by paying your home off faster with a shorter mortgage term, therefore you're going to earn the equity in that property faster. And you have a quicker payoff. You're going to own your home outright in half the amount of time using a 15-year mortgage than what you would be doing if you did a 30-year mortgage. And you have long-term savings when you get a 15-year mortgage, meaning the total cost of the loan is lower, leading to significant long-term savings. Stability is another important thing that you want to consider and would be a pro of a 15-year fixed rate mortgage. Fixed payments provide a consistent budgeting framework when you're buying a home. So a 15-year mortgage, really any fixed rate mortgage for that matter, will provide that consistency to you. Now let's talk about some of the cons of a 15-year mortgage. Well, for one, the most obvious is that you're going to have higher monthly payments. The payments will be substantially higher on a 15-year mortgage than if you were going to take a 30-year mortgage. So you really need to consider this because it'll put more strain on your monthly budget. You're going to have less flexibility, meaning you have less room in your budget for other investments or other unexpected expenses that might arise once you take ownership of a property. You may also run into qualification challenges. Because there are higher payments that come with a 15-year fixed rate mortgage, it may be harder to qualify for the loan using that shorter term, specifically when it comes to your debt to income ratio, meaning the amount of money you make monthly versus your monthly expenditures, including the new proposed mortgage. And something you may not consider is opportunity cost. So investing extra money that you're putting into your mortgage could potentially yield higher returns elsewhere. So rather than having a 15-year payment, which we said is higher, that difference between what a 30-year payment would have been and what a 15-year payment is could be invested elsewhere and actually make you money versus being stuck with the higher payment that comes with a 15-year mortgage. So those are very important to consider when looking at your 15-year. Now let's look at a 30-year in comparison. So once again, we'll start with the pros. Well, you're gonna have a lower monthly payment than you would if you were to have a 15-year term. This is because you're paying for double the amount of time. The payments are more affordable because of that longer term. You're gonna have more budget flexibility. Because you have lower payments, you're gonna have better monthly cash flow and you can invest that money into other things, right? You're paying less. There's more free cash. Do whatever you please with that money. If you have something pop up that's unexpected, well, now you have money available to take care of those things. There are also more tax benefits. Now, there's a tax benefit to any mortgage. However, you're going to have an interest deduction for a longer period of time on your tax returns, which helps bring down your taxable income that you're actually paying to the IRS. There's gonna be easier qualifications for a 30-year mortgage in the sense that the payment's lower and therefore your debt to income ratio would be lower on a 30-year mortgage when comparing it to a 15-year mortgage and the higher monthly payment that comes with it. And investment potential. The money you're saving monthly on a 30-year mortgage in comparison to a 15-year mortgage can be invested elsewhere, potentially yielding higher returns. So just like a 15-year mortgage, you still have the same stability, right? Because it's a fixed interest rate, and we talk about fixed rate mortgages are going to be more stable than an adjustable rate mortgage. So you really get that stability with a 15-year and a 30-year. The biggest difference is the payment is more affordable on a 30-year for most people than it would be on a 15-year. Now, let's talk about some of the cons that come along with taking a 30-year mortgage versus the shorter term 15 years. So you're going to have a higher interest rate, right? I talked about the rate on a 30-year mortgage being higher than that of a 15-year mortgage. Now, in today's market, it's only about a difference of 0.5%. But as I mentioned before, when rates were at their lowest point, it was a full 1% difference in the interest rate. So if you're going to take a 30-year mortgage because the bank or lender's committing to that interest rate for such a long period of time, well, it's going to come with a higher interest rate than what you would get on a 15-year mortgage. You're also going to pay substantially more interest overall. So the longer term means that you end up paying more interest over the life of the loan. You're going to have slower equity buildup than what we talked about on the 15-year. Now, once again, like I said, your home's going to appreciate at the same rate whether you have a 15-year mortgage or a 30-year mortgage. What we're referencing specifically here when we talk about equity buildup is the equity you're gaining by paying down the loan, right? The less you owe on the property, the more equity you have in that property. And you're going to have a longer debt period with a 30-year mortgage. Naturally, if it's stretched out over 30 years, you'll pay the debt for a longer period of time. So that can have implications for long-term financial planning, especially for retirement, right? Maybe you need to get rid of or want to get rid of your housing expense prior to retiring. Well, depending on your age, this is something that you need to consider. Now, if you don't want to be stuck with the high payments that come along with a 15-year mortgage, but you also don't want to pay interest for 30 years, here's a trick that you can use to cut a significant amount of years off of a 30-year mortgage, saving you tens of thousands of dollars in interest. So this is by making bi-weekly mortgage payments. Rather than making your full mortgage payment once per month, 12 times per year, you're going to make an extra mortgage payment immediately after closing on your home, and then you're going to make a half payment every 2 weeks going forward. Doing so will reduce the amount of interest you pay by cutting 7 years off of a 30-year mortgage. And in that 7 years, you can save tens of thousands of dollars in interest. Now, there are more loan terms available than just a traditional 30 and 15 year. So it's important that you work with your lender to find the term that best suits your needs and goals. Feel free to leave a comment or question for me below, and I will respond to you personally And make sure to follow me for more videos just like this one.